So you might have glanced at the overall market recently, seen a tiny little dip, and thought, no big deal. But let me tell you, under the surface, some of the most popular stocks, maybe some of yours, have been getting absolutely hammered. Let's dig in and figure out what is really going on here.
And, that's not an exaggeration at all. While the S&P 500 might have been down just a tiny fraction of a percent, the story for a lot of those retail favorite stocks was, well, it was a completely different world. It was a bloodbath, an obliteration, for real.
I mean, just look at these numbers. You've got Palantir down over 9%, Duolingo almost 8%, Robinhood and Hims both dropping 6.5%, Coinbase down 6%, and Kava hit a brand new yearly low. These are not small moves, folks. This is serious carnage, and it's all packed into some very specific popular names.
So that leads to the big question, right? Why? Why are these stocks falling off a cliff while the rest of the market seems fine? Well, it turns out there's a really important thing to understand here.
Because here's the key. A falling stock price, that's just a symptom. It's not the actual disease. If you really want to understand why your favorite stock is dropping, you have to diagnose the right problem first. It is definitely not a one-size-fits-all kind of idea.
So let's use a simple framework to break this whole thing down. Really, there are only about 3 main reasons a stock gets into trouble, and figuring out which one or which ones are hitting your stock is absolutely crucial.
Okay, here they are. First, you've got a fundamental problem. This is when the actual business itself is struggling. Maybe sales are slowing way down, something like that. Then you have a valuation problem. Here, the business could be amazing, but the stock price just got way too high. And finally, you have a stock price problem, which honestly is usually just the market reacting to one of those first 2 issues.
All right, now that we've got our little diagnostic kit, let's put it to work. We're going to apply this framework to some of those stocks that got hit so hard and see what's actually going on under the hood.
Let's kick things off with Palantir. So is there something fundamentally wrong with the company? Nope, not at all. In fact, the business is described as amazing. The problem here is purely 100% a valuation issue. The stock price just flew so high that it was basically in a different orbit from the actual business performance.
And just to give you an idea of how wild it got, there's a very strong case to be made that Palantir recently became one of the most insanely valued companies for its size ever in the entire history of the stock market. When a stock's valuation gets stretched that thin, it really doesn't take much to trigger a huge drop, even if the company is doing great.
Now, this is where it gets really interesting. Let's compare Palantir to Hims. See, Palantir has that clear-cut valuation problem. Hims, on the other hand, well, it has a potential fundamental problem. There are government investigations swirling around, and that's created this cloud over its future. There are real, serious questions about its future growth. So you've got 2 stocks, both dropping hard, but for totally different reasons.
And then there's Kava. Kava is basically dealing with the perfect storm. It's got the trifecta of trouble. Fundamentally, its sales growth has just tanked, dropping from over 20% all the way down to 2%. That, of course, creates a stock price problem, and to top it all off, it still has a super high valuation. When you get all 3 of those problems hitting at once, you get a violent drop like the one we've been seeing.
Okay, so that helps explain what's happening with these individual stocks. But let's zoom out a little bit. What does all this chaos mean for the market as a whole? This is where a pretty fascinating debate is happening right now.
The big question on pretty much everyone's mind is this. That sharp drop we saw back in April, was that the end of something? And are we now at the very beginning of a brand new bull market? Or was it something else?
You've basically got 2 very different ways of looking at this. On one hand, you have Morgan Stanley's Mike Wilson. He was a famous bear for a long time, and now he's saying we're at the beginning of a new bull market that kicked off in April. He thinks that drop was the final give-up moment. But the analysis we're looking at today says, nope, that April drop was just a severe correction inside a much longer bull market that's been going on for years. So in this second view, the timeline is way longer. The real bull market, it argues, actually started way back at the bottom in October of 2022. We're now coming up on a 3-year run. So that dip in April, yeah, it was painful for sure, but it was just a correction along the way, not the start of some whole new thing. All right, so with all this chaos and these 2 different views, how is an investor supposed to react to any of this? And this really brings us to what might be the most important part of this whole thing, understanding the psychology of the game. Because here it is. This is the single biggest mistake that so many people make. Way too often, investors do the exact opposite of what they should be doing. They get swept up in all the emotion, and as our source puts it, they end up playing the game completely in reverse.
And here's what that looks like in the real world. Step 1, you pour all your money in when the market is hitting all-time highs, and everybody on TV feels like a genius. Step 2, you panic and sell everything when the market inevitably crashes. It's the classic buy high, sell low, driven 100% by fear and greed.
Palantir is such a perfect example of this. The emotional but totally wrong move is to feel all that euphoria and buy the stock at its peak of $166, but then be absolutely terrified to touch it when it was trading for just $6 during the crash in 2022. The logical thing to do is the complete opposite, but man, it is so much harder psychologically.
And this brings us to a really crucial point. The source here makes a powerful argument that you can never ever let your political views drive your investment strategy. The crash in 2022 was a massive, maybe once-in-a-lifetime opportunity. A market crash is a buying opportunity, period. It doesn't matter who's president.
Which really leaves us with this one final critical question. This volatility isn't going away. There will be another crash. There will be another correction. The real question you have to ask yourself is, next time it happens, are you going to be playing the game forward or in reverse? Are you prepared to see that dip not as a reason to panic, but as the massive opportunity it really is?